Hey, what's going on, everybody, and welcome back to my channel, The Real Estate Real. I'm your host, Tyler, and today what we're talking about is creative funding solutions for investors. And we're also here today with our special guest, Marissa from Reliant Lending. So welcome, Marissa.
Thank you. Thanks for having me.
Of course, of course.
So today, Tyler and I are here because we wanted to talk about what's going on in the market, what kind of things are going on, what kind of things do investors need to keep an eye out for, and what are some solutions for them. So we were obviously we know the state of the world is pretty crazy right now, as it has been for the last couple of years. So I'm curious, how's that working out for you in the market? What are you seeing? Is there any big changes or everything kind of the
There
same?
hasn't been a drastic amount of changes yet. There's still a lot of people that are kind of on the sideline waiting to see if the market's going to drop a little, which it hasn't. The demand on the market is still really high right now. Buyers who are looking to get into the homes where they've got outbid or anything like that are still looking to actively get into a home that they want, of course. And, we're still seeing that demand really high right now. So what are you kind of seeing with interest rates right now? How are interest rates right now?
Yes. So, we even were together making a video not long ago. People may have seen, we talked about, we'll see that steady increase, that rise. And I was kind of thinking we'll see some big dips throughout the year. And we've already seen that quite a bit. We've seen some dips up, some dips down. And most recently, we're seeing a pretty big dip up. So, or not a dip, I should say, a spike up. So for those with 20% down, credit score of around 740, we are seeing around 4.3. For those with a credit score of around 680, we're seeing around 4.75. So big difference just depending on that credit score.
Interest if your credit is only 60 points lower than what it would have been. And 680 is still a great score for a credit score, I believe.
Exactly.
But, just having those little differences, just so you know, that is what we're trying to portray to you today. If you have an increase in right now in 60 points in your credit score up to 740, you could have a substantial decrease in your mortgage right now. So
yes, exactly.
of course, that's really awesome. And of course, we're here talking about investors today, so we're going to jump right into it. How do you see just regular loans, like conventional loans? I guess I shouldn't call them regular, but most used loans like conventional loans and FHA loans. How do you see investors benefiting from those loans?
Yeah, so though, sometimes keeping it as simple as possible is the best route. Putting 20% down conventional loan with a good credit score is going to get you, the best margin of profit there. So sometimes simple is best, but it may not always be easy. So for first-time investors, something like an FHA could be great because of that lower down payment. But as he's saying, supply is pretty tight. So maybe doing something like a conventional with a lower amount down is possible.
Definitely, yeah.
So simple is sometimes best, but there are lots of creative options that should be explored regardless. So that simple option is the best option.
Right, yeah. Definitely what Marissa is trying to basically say is that if you're using an FHA loan right now in this high demand market, it's often a lot harder to get accepted by sellers right now. So conventional loan, if you're putting more down, obviously that's going to make your bid more competitive, and it's going to probably most likely it's going to give you a higher
chance of getting that offer accepted.
Right, higher chance of getting that offer accepted a lot. And that's just with conventional loans and things like that. But if we're starting to talk about, you mentioned creative ways to, do financing and things of that nature. I know a HELOC is a really good option if you already own your house. What a HELOC does is if you haven't heard of it before, it's extended line of credit on your house pretty much. And what it will do is if you already have equity in your house, it will allow you to take the equity out of your house and use it pretty much as credit if you want to buy another house. So a HELOC is a great option if we're talking about it like I am right now. But what other creative ways have you seen to, finance these home loans and things of that nature?
Definitely. So HELOCs are a really great option. That's really a great way to leverage the equity that you already have. Other creative options, things that are going to be much more popular, 80-10-10s. down payment assistance as a supplemental option and maybe taking some cash out. So that 80-10-10 is really meant to help reduce that mortgage or help get you to that next level by maybe taking away mortgage insurance, which could be an extra $400-$500 a month, and that extra $400-$500 could make a big difference in what you qualify for. So all of a sudden you can go up, several $1,000s, however much it may be, depending on your specific situation. So that's one creative solution. Down payment assistance programs can be used for first-time investors as supplemental means. It doesn't necessarily mean that you should have no money going into it, or that you need to be of hardship or anything of that nature, but it can just be a tool to maximize what you can qualify for and things of that nature, or maximize how much you're putting down.
Absolutely.
Especially for teachers especially, mostly because there's not really a limit for how much teachers can use. Usually there's about a $15,000 limit with those down payment assistance programs. So teachers can go up, a little bit more, much more, depending on where they're at. The last one I would say is that cash out refinance. Obviously, we know rates are going up, so this has to be done carefully. It has to make sense for your specific situation. But if you're sitting on a lot of equity, you would know leveraging that equity to buy another property. Would you say that's a good option?
Definitely. Right now, since we've been talking about interest rates going up a little bit, it might not be as good as option as it was about 6 months ago.
Definitely.
When rates were really lower. But I definitely always, recommend
checking.
Definitely check. And obviously, if you're an investor, you're not trying to spend your own money all the time because you have your money tied up into a lot of things. So if you can use that equity on your house, then I would definitely recommend using the equity already on your house, as Marissa was saying.
And I would say, with your own home, maybe not so much, but maybe you have someone who has, a 4-unit dwelling and they are cash flowing quite a bit. So they might still be able to cash flow even with that cash out refinance, just depending. So if you have a lot of equity, it might be an option, but you're right, it's definitely not the time to refinance for the traditional scenario.
Most people most likely, I assume that you refinanced. A lot of people I've seen lately have refinanced in 2020 and 2021 just because rates were so low. It was definitely a smart decision to do so. And if you're trying to do so now, you definitely have to beat the old rate out that you already had. And if you're not going to beat that old rate out, then you just can't refinance pretty much. So as far as my knowledge, you can refinance, but you never want to refinance at a higher rate. So, but I don't know if you talked about creative loans for investors. What do you see some ways that are available to maximize their profit margin right now?
Yes, so in the beginning we talked about those interest rates, right? And we gave those two examples of the 680 credit score and a 740. 680 credit score gets you most of the loan products. That's the minimum for down payment assistance and a lot of things like what we talked about. So right now, more than ever, having a good credit score, the best credit score that you can have, is the best way for you to save money now and long term. So that's a big difference in rates that are offered to you as well. Another thing to keep in mind is if you are going for, a high balance loan amount, meaning over 647, consider staying under that number, because after you pass that threshold, you're having some big jumps in interest rates as well. Another thing, we kind of touched on it, a couple things that we touched on, leverage the equity that you have if it makes sense. So contact a real estate professional like Tyler. He can help you with that. Or find ways to get rid of mortgage insurance. And that is kind of what we talked about with the 80-10-10. That's kind of the idea around that. That may not be its intended idea, but that's kind of one of the byproducts that come out of that. So any ways to, reduce that mortgage or get rid of that mortgage insurance. Actually, funny enough, if you can't get rid of the mortgage insurance, you can make it cheaper by having a good credit score.
Absolutely. Any way possible that you can save extra on funds, obviously, as an investor, is what you're going to be wanting to do, because there's a lot of times when you'll have to spend money on other things that you weren't preparing for, possible, property damage or anything of that nature. So you always want to have a little extra funds over and not put all your eggs in one basket, so to speak. So.
And the last couple things that I would say, things that you may not think about. Try adding a co-borrower. If you have, a parent, a sibling, somebody really close that you trust and are willing to do something with, adding a co-borrower can change what you qualify for. Maybe they have good credit, whatever it may be. And also consider, if you're investing, consider investing close first. Maybe getting a second home for, a child who's already paying rent, or a family member, a close family member that is already, paying rent, and would be willing to do the same for you.
Absolutely. So that's all we pretty much have for you guys today. I mean, we covered a lot of topics from conventional to HELOCs to 80-10-10. I hope some of this resonates with you and obviously brings you value. That's what Marissa and me are here for. So I hope it did bring you value today. And of course, we're signing off now. And thanks for watching and tuning in. Of course, like and subscribe. And thank you.